Okay, so hello everybody. Welcome to our webinar today. Our webinar is Understanding the National Mortgage Settlement, a Roadmap for Housing Counselors, Part 1. Today is June 17, 2013. This webinar is brought to you by the National Consumer Law Center and the National Housing Resource Center. My name is Jessica Hemans. I'm the training coordinator here at the National Consumer Law Center. Before we get started, I wanted to go over a couple technical tips. If you are listening via your phone audio, please enter your PIN number into your phone. It's helpful to enter the pound sign, the number, and the pound. It's between 1 and 3 digits, and you need to enter that into your phone, not into the computer software. If you're listening on your computer, you do not need to worry about a PIN number. But if you are listening via a microphone or headset on your computer, please be sure your device volume settings are properly adjusted. If they are not working, try unplugging and replugging them in. Everybody is muted during this webinar, and I am recording it. If you want to minimize your control panel, you can just click on the arrow and it will go away. We are going to take questions throughout the webinar, and then at the very end, please type them in and we will relay it to the speakers. There is an evaluation at the end of the webinar. You will just exit out and it will pop up on your screen. And at the end of this whole entire series, I will give everybody a copy of the PowerPoint, the recording, and the handbook. So you will get a copy of that, but not until the very end of the series at the end of June. So our presenters today, we have Odette Williamson. She is a staff attorney here at the National Consumer Law Center since 1999. Prior to this, she was an assistant attorney general in the Massachusetts Office of the Attorney General, where she concentrated on civil enforcement actions against individuals and businesses for violation of consumer protection and other laws. So welcome, Odette. We also have Bruce Dorpalen. He is the executive director of the National Housing Resource Center. The National Housing Resource Center is an organization advocating for the nonprofit housing counseling community, and he is also going to be serving as our moderator today. So welcome, Bruce. We also have Ellen Bardeen. She managed a housing counselor program in Columbus, Ohio for 9 years. In that role, she counseled hundreds of pre-purchase, post-purchase, and foreclosure clients. She also trains housing counselors for national intermediaries. We have Joseph Chambers. He is an assistant attorney general in the finance department of the Connecticut Office of the Attorney General. He assisted Attorney General George Jepsen with the investigation and negotiation leading up to the national mortgage settlement and represents Jepsen on the National Monitoring Committee. And we also have Michael Moore, who is also an assistant attorney general, but with the Florida Office of the Attorney General and the Tampa Consumer Protection Division. So welcome to all of our great speakers today. So the National Consumer Law Center, where Odette and I work, it advocates on behalf of low-income consumers. We provide training, legal analysis, case consultation, and advocacy on consumer law issues. We also provide in-person and online trainings, just like this one, to housing counselors and attorneys. We also create books and manuals. Please visit our website at nclc.org to learn more. And now Bruce is going to talk about the National Housing Resource Center. Hello, Bruce.
Glad to be here and welcome everybody. The National Housing Resource Center just started last August. Hopefully you've heard about us. We are an advocacy organization for the nonprofit housing counseling community. We're working on getting increased funding for housing counseling and getting housing counseling agencies into the policymaking arena and having a seat at the table. And you may have heard about a number of our activities. We had a sign-in letter on the HAMP extension, which advocated for extending more than a year and also increasing the pool. They did extend until December 2015. Many of your organizations signed on to this. Thank you for your help there. We got in the OCC's recent settlement, we got housing counseling to be included as soft money in the resolutions and ended up generating $23 million in new housing counseling contributions to organizations. We helped develop and get implemented the new MHA program for outreach and referrals on HAMP applications, which had $10 million in new TARP money going in to housing counseling agencies. And just recently, 2 weeks ago, we released our survey of housing counselors. Some of you contributed to the survey. It was a survey on how effectively the servicing standards were being used in the settlement and how the servicers were actually implementing it. And there was a lot of troubling information from it. 73% of the respondents reported that their clients had not received decisions on loan mods within the 30 days of application. 68% identified problems of losing borrowers' documents, either frequently or sometimes. 62% reported incidents of dual tracking, at least one and often more than one incident among their clients. And then we had a record of lots of problems with people with limited English proficiency, which is more of a fair housing issue, fair lending issue, but one that's relevant to lots of our groups. I think part of the goal in these webinars are to really, there's a lot of excellent stuff in the servicing standards that's very helpful, that really needs to be implemented. They've been in effect for a year now, and I think one of the values of these webinars is to both make you aware of what the rules are so that you can definitely inform people in the servicing community when you've got cases there. But it's also, Ellen and Odette will go through in great detail and in very helpful detail about exactly what the servicing standards are. And there'll also be a tool that you can use. It's an online checklist that will allow you to take any case, upload the information on the case, and then go through the list and figure out where the servicing standards were followed and where they were not, checking off those places where there were violations, and then refer those to your local state AG, refer them to the Office of the Mortgage Settlement Oversight, refer them to HUD if it's a fair lending violation, and referring them also to the CFPB, the Consumer Financial Protection Bureau. So hopefully this will all be very helpful to you all. We want to welcome you. We're glad you're on the call. You'll be an important part to helping make this valuable tool work more effectively. And with that, I'm handing it back over.
Thank you, Bruce. And now we're going to have Odette start the presentation.
Great. Welcome, and thank you, Bruce. Thank you, Jessica. Again, my name is Odette Williamson. I'm a staff attorney here at the National Consumer Law Center. And along with Ellen, we will be walking you through the servicing standards under the National Mortgage Settlement. Now, we designed this course as a two-part course because for those of you who are not familiar with the servicing standards, there are about 304 standards. We certainly aren't going to go through 304 standards, but we want to give you the highlights, the most important aspects that you as housing counselors have to be familiar with. And just when you thought that the servicing standards was all there is to know about, recently in January, the Consumer Financial Protection Bureau announced that they too had developed some standards for servicers, and that those standards will apply to the whole industry, and those standards will take effect in January of next year. So we will not be discussing that on today's webinar, but we certainly would be remiss if we didn't give you the highlights of those servicing standards as well. So we'll discuss those next week. So on today's agenda, what we'll be discussing is the servicing standards. The settlement itself is multifaceted. We'll do a brief overview, but we will be focusing like a laser beam on those standards so that you're comfortable with what it is that servicers, the 5 servicers, are required to do according to this agreement. We will be talking about putting those standards to work, looking at the tips and tools that were developed and are part of the standards that can help you in your day-to-day work with your clients, in your day-to-day interaction with servicers. And finally, we will be discussing, as Bruce kind of teased you about a little bit, we'll be discussing a great tool that we've developed for housing counselors. It's a really simple checklist and a way for you to record what you believe are any violations that you've seen in your client's case file with respect to these standards. Where are they falling down? Where are they not meeting the guidelines or the requirements that they're supposed to meet under these standards? So we'll introduce you to that tool, and we hope that that tool will become a regular part of what you do when you help your clients, that as a part of your job that you will be looking to see, well, is there something here that didn't go according to plan? Is there something here that I should report out or I should seek additional assistance on? And next week's session, we'll be continuing the standards. As I mentioned, there are 304, but don't worry, we won't be doing all of them. But we certainly, next week, we'll be doing important standards like the standard for dual tracking of foreclosures. That is when the servicer pursues or goes ahead with the foreclosure process while a loan modification application or an application for a workout is under consideration. Those CFPB mortgage rules I mentioned, those are coming up next January. We'll kind of compare and contrast what those rules and how they are similar to and how they are different from the standards set under the National Mortgage Settlement. But of course, first we have to be comfortable with what the National Mortgage Settlement requires. We'll talk about escalating problem cases, who do you go to for what, and how do you deal with some of the more problematic parts of helping your client with a workout. You will be receiving, I think Jessica mentioned, you'll be also receiving a handbook. And feel free to take notes, but if you don't want to take notes, everything we discussed today will be in that handbook. The handbook not only discusses the settlement, but also has an outline of the CFPB rules. And in the back of the handbook is a simple chart that compares side by side what is the rule under the CFPB servicing standards and how does that compare to the rules under the National Mortgage Settlement. So you'll see side by side that there is actually more commonality than not, but certainly the National Mortgage Settlement is a lot more comprehensive. So let us get started. What is the National Mortgage Settlement? I'm sure many of you on today's call have heard of it and probably have sat in on a few webinars discussing the settlement itself. So let's just walk through a broad overview before we start to talk about the servicing standards which are incorporated as part of the settlement. So the settlement was reached last year, and it's simply an agreement between 5 of the leading and biggest servicers with 49 state attorneys general, the federal government, and of course, as I mentioned, the 5 leading servicers. And the aim of the settlement is to address abuses that have been identified in the servicing of mortgage loans. And those are loans, residential mortgage loans, not commercial loans, as folks know. And really, this settlement came about because the federal and state government started investigating the robo-signing of affidavits. And that's simply where you have these individuals, or sometimes in other contexts just a machine, signing thousands of legal documents without reviewing the accuracy of the information contained in those documents. And that was what started the investigation, but it didn't stop there. The investigation expanded to look at other types of abuses in the servicing of loans, including losing the documents over and over again, dual tracking, as we mentioned before, taking too long, months and months to respond to a submitted application. I mean, the list goes on. But at the end of the day, a lot of consumers were losing their homes unnecessarily and without really being given a fair chance at saving the home. The investigators, or the folks that really started this investigation, as you can see, it's pretty comprehensive. We mentioned 49 states, but also, HUD, DOJ, U.S. Attorney's Office. So it was a really broad-scale collaboration of the state and federal government looking at this, and that's why the settlement is so broad and comprehensive in scope. But it also provided for billions of dollars in either money or other types of assistance to homeowners and former homeowners. We won't be, unfortunately, concentrating on those types, that part of the settlement. So that part of the settlement is referred to as the consumer relief provision. So fair warning, folks, we won't be talking about that today, but certainly a big part of the settlement had to go deal with the money and other types of assistance. $25 billion, which is roughly broken down into $20 billion of direct or indirect assistance to homeowners, and $5 billion, which went to cash payments to the state or federal government. So when you see this chart, you can see that the biggest bulk of the $20 billion, which is on the green shaded boxes, the biggest bulk of the $20 billion went to various anti-foreclosure measures, whether they be modification of first lien mortgages or second lien mortgages, short sale help to the states and localities which were dealing with the residual of the foreclosure process, with a lot of the boarded up building and a lot of the police and extra police and firefighters that was necessary to police those buildings. The bulk of the money went to those initiatives. There was $3 billion given to refinance homeowners who were underwater. Now, if you look at the other side, the blue box and the sort of tan-colored box, that equals the $5 billion remainder, and a bulk of that went to the state government, and they created various initiatives. I'm sure you probably more than familiar with the initiatives in your state, but some of them created initiatives to help homeowners provide direct foreclosure assistance, maybe housing counseling, to fund housing counseling, to fund legal services, things like that. And some of the money also went to, the remainder of the money went to the federal government. So who are the 5 servicers? Now remember, when we talk about the agreement, it was simply an agreement between the government, the federal and state government, and a select group of servicers. You've heard these names before: Ally, JP Morgan Chase, Wells Fargo, Bank of America, Citi, are the 5 that signed on to the agreement. But as you can see, one of these folks, and I'm sure you guys know, has filed for bankruptcy, and that would be Ally, also known as GMAC. They filed for bankruptcy last year, so they are no longer doing servicing, and they've transferred or sold their servicing to Ocwen and Greentree, which is taking over the servicing of loans that were formerly serviced by Ally. Now let me say that Ocwen and Greentree have agreed to abide by the servicing standards. So even though Ally is no longer in business, the loans that they used to be serviced are supposed to be serviced according to the servicing standards outlined in the settlement. So let me start with a first poll question, a really easy one here, folks. Who were we? I told you, gave you a hint already that certainly the top mortgage servicers were the ones that signed on to this settlement. So why don't we start with an easy question? Who was a top 5 mortgage servicer at the end of 2012? Was it A, Chase, B, Wells Fargo, C, Citi, or D, all of the above? And Jessica, is the poll open?
Yes. So please fill it out for us. We'll give you about 15 more seconds. Okay, 5 more seconds. All right. So a debt, 9 people said it was Chase, 9%, 17% said Wells Fargo, 4% said Citi, and 75% said all of the above.
All right, awesome. It is indeed all of the above. As you can see, this is the 3rd quarter of 2012, so not quite the 4th quarter, but I don't think the stats probably changed that much from quarter to quarter. What surprised me was I thought Bank of America would be in the first position, but it appears to be Wells Fargo. So yes, all of these folks are top servicers. And certainly in terms of, scope, by targeting the top servicers in the industry, you're really covering the folks that have the biggest market share and service the bulk of the loans in the United States. So the settlement and the servicing standards in the settlement have really far-reaching impact on the industry. So we're talking about this the settlement and the money, but there were other important things that were negotiated as part of this process. And just to give you a bird's eye view, we won't go into detail on this, but the governments, the state and federal governments, gave up the right to pursue these 5 servicers for certain things. 3 of them generally are to pursue the servicers for conduct related to servicing of the loans, for how they processed the foreclosure, and also for how they originated the loan. So they gave up that right, but they didn't release certain rights, certain legal rights to go after these servicers for. And certainly you see the list on the right, criminal conduct, they certainly can still go after them for that, for securitization, how they securitize these loans with Wall Street, fair lending claims, if they unfairly treated individuals unfairly who were part of protected classes, and we can talk about that a little bit later, and to go after them for any claims related to MERS, which is the Mortgage Electronic Registration System. But most importantly, on this list, the most important right that they did not give up was the right of third parties, in other words, your clients, the right of your clients to sue the servicers if they have a dispute. So in other words, they did not waive or release any legal claims that your client may have if they've received bad or shoddy servicing, or if the servicers have violated their legal rights in any way. They can still, your clients can still sue. Under the terms of the settlement, the way it's structured, the servicers get credit for engaging in certain activities that are outlined as part of the settlement. And we'll go over what those activities are in bird's eye view. But generally, they'll either get full or partial credit for engaging in various activities, whether it be providing the homeowner with a modification, first or second lien modification of the loan, which writes down the principal, or whether they do things like refinance the homeowner, they get credit for certain, a whole slate of various activities rather, including doing short sales and other things we'll discuss in a minute. But in terms of the financial assistance that homeowners get, there is a first lien and a second lien modification program. First lien, which involves writing down the principal amount of the loan. Second lien, which involves a write down or complete what they call extinguishment of the second lien. There's also a refinance program for homeowners who are current but underwater, and actually with both of these, the first and second lien modification program and the refi program, both of these programs target homeowners who are underwater, which means that they owe more than on the mortgage than the home is worth. With respect to the second lien, the refinance program, the servicers will be the ones reaching out to your clients, reaching out to homeowners to tell them that they are eligible for these for this part of the agreement. Let me say that we'll talk about OMSO and the Office of Mortgage Settlement Oversight in a minute, but they have some fabulous reports, and according to some of the information that's on that website, the servicers are nearly finished or really near completion on in terms of satisfying their obligation under this part of the settlement. The other forms of assistance that is required or that the servicers will get credit for, remember I said they'll get full credit, partial credit, for providing various forms of assistance. Here's just a sample. This is not a comprehensive list, but a sort of a sample of what other forms of assistance they have agreed to provide, including forbearance for unemployed, principal forbearance for homeowners who are unemployed, assistance in short sale. There's a outline of a whole short sale process, including time frames. We don't really cover that in this course, but realize that that information is written up in the manual that will be available to you. If they waive deficiency balance, say if there's a short sale and there's a deficiency and they agree to waive it, they can get credit under the settlement for that. And in addition, there are various and very detailed protections outlined in the settlement for military service members. And what's especially important about these protections is it protects military service members who have to move because they're deployed. They're deployed perhaps at a different area or maybe overseas, and they have to move quickly, and they may sell, and it may result in a short sale. But there is a whole section that outlines what protections that are to be given to our military servicemen and women. One other initiative that is written in and that servicers get credit for, the 5 servicers, is for working with state and local governments to really go after some of the blight and the other outgrowth of the foreclosure process. So not a detailed section, but certainly they will get credit for working with the state and local municipality on various, whatever initiatives those governments come up with. So in terms of total consumer relief, I mentioned early on that the servicers are pretty near, or they're at least very far along in terms of fulfilling their obligations to provide various forms of monetary and non-monetary assistance to consumers in local and state governments. And you can see from this chart, this is from OMSO, the Office of Mortgage Settlement Oversight. This one's a little dated. It's February 21st of this year. But, well, not too dated, but certainly what you can see is that the majority of relief that's been given so far is in the form of modification, whether it be first lien or second lien, and also short sales as well. I do have some updates on information that was released just in March of this year to give you a sense of where we are with the settlement. As of March 31st, about 622,000 homeowners have received some form of benefit from the settlement. And by benefit, we mean mods, refi, maybe relief from deficiencies, some type of relief. And that translated into $81,437 per borrower. So that's how you break it down, the relief that each person has received so far. 92,000 folks, homeowners, have successfully completed a first lien modification and received about $10 billion in loan principal forgiveness. And 14,000 borrowers are still in active first lien trial mods as of March 31st. So we have about 14,000 people still working their way through on the trial modification plan. And sorry, folks, sometimes my computer is a little sticky here. So what about other forms of relief? Well, one that you may have heard of is the settlement provides for money to folks who have been foreclosed on, and the homes had to be lost between January of 2008 and December of 31st of 2011. The eligible former homeowners should have received a letter, and the deadline to submit that claim form was January 18th of this year. And I believe I checked the National Mortgage Settlement website. There is an update. I believe the checks are rolling out as we speak. Joe or Michael, do you have any updates on that?
Sure. Checks. This is Joe Chambers of Connecticut. Checks began mailing last Monday, and they're going to mail over the course of about 7 days, so they should wrap up this week, early this week. There are approximately 1 million checks going out, and the amount per loan is $840.
Great. Thanks.
I'm sorry.
For that.
I'm sorry. It's $1,840. I'm sorry.
Oh, okay. Well,
it's up. I'm sorry. It's $1,480. I just transposed the number. So $1,480 per loan amount.
okay, that's fantastic. So if you have, I know many of you are helping homeowners who are currently in foreclosure, but certainly if you have in your database folks who will be receiving this check. This is a plea from me. Certainly there's a lot of fraud associated with foreclosure rescue scams and other types of fraud, so you might want to start alerting people that the checks, they'll be receiving these checks, and that they certainly don't need to do anything to receive anything more to receive that money. So key to this settlement is the way that the settlement is designed to be enforced. There is a whole enforcement mechanism. We will just give you the highlights. But there are a series of metrics that the servicers, the 5 servicers, have to comply with. And metrics are just a way, it's just a fancy term, a fancy way of measuring the servicer's compliance with the servicing standards and the other consumer relief activities that are outlined in the agreement. There is a monitoring committee, which is composed of 14 states and HUD and another federal agency, which will oversee the servicer's compliance with all of these standards. And if there is a pattern of significant uncured violations of the settlement, then enforcement action may be taken. And that is just a fancy way of saying that the servicers, if there is a violation of the term of the settlement, they will be given the opportunity to cure or to correct what that violation is before there is an enforcement action. But certainly if there's a pattern, they may face an enforcement action. And Ellen, did you want to talk a little bit about the bank?
Yes. Well, one of the details here is that the banks have 3 years to meet these requirements, and also that if the loan servicing is transferred, then the new servicer is obligated to accept and continue processing the loan modification, which is great news for housing counselors, because I know it is so frustrating when we're in the middle of helping a borrower apply for modification and we experience that servicing transfer. And in the past, we may have been asked to start that application over again, and under the settlement, you shouldn't have to. They should have to continue to process the application that's already been submitted.
Great. So Ellen mentioned 3 years. So this settlement will run till about mid-2016. But certainly, as I mentioned, the servicers are far ahead in terms of providing the relief, the mods, and the other type of relief that are required. One of the important ways that this settlement is enforced is through the establishment of OMSO. I mentioned OMSO a couple times, so let me define what is OMSO. OMSO is simply the Office of Mortgage Settlement Oversight, and it was created under the settlement, and it is dedicated to measuring the servicer's compliance with the servicing standards and other terms of the settlement. The monitor is Joe Smith. He's the former Commissioner of Banks of North Carolina, and I know Joe Smith has reached out in a variety of ways to housing counselor and the housing counseling community, really seeking information from you on how are these servicers doing. Are they living up to the servicing standards? Are they treating your clients fairly? And he works with the monitoring committee, and OMSO has set up a really fantastic website, which, as I mentioned, has a ton of reports on there, has facts and data about what's happening with the settlement. But one of the most important parts is information on how to report the violations of the servicing standards. They have a form that consumers can fill out. They also have a form that professionals like yourself, like counselors, like attorneys, and other advocates can fill out to report whether the servicers are violating the servicing standards. And the reason why that is important is that, as I mentioned before, these folks are listening, by these folks, let me define who that is, the monitor committee, also are looking for patterns of violations. So the more information you supply OMSO, the more information you supply to us through our checklist, which we will go over later, the more information that they have, if there is, in terms of what's, how your clients are being treated, if there's a violation of the agreement itself. One caveat, Joe Smith has reached out, and we certainly, when we collect our information under our checklist, we'll be providing OMSO with the data that we collect. But OMSO's role is limited to collecting the data. They will not mediate. If you have a dispute with the servicer, they will not act as a mediator. We will talk next week and later on about some of the avenues you have for escalating the cases, but certainly a lot of the state AGs have established programs where they work directly with housing counselors and work in a capacity as mediators to see if they can resolve the conflict or resolve any problem. So we'll talk a little bit more about that, but just wanted to alert you to that fact. Joe or Michael, did you have anything to add about OMSO?
Odette, at that website, if you go there and you hit that updated consumer relief, what you'll find out is those numbers that you reported back on slide 24 have been updated to show that total consumer relief provided to date is over $50 billion. And there was a recent report issued by the Monitor on May 21st, 2013, and your audience can go to that website and download it and find out all the latest data about their state.
Great, thank you. So we're going to stop here for any questions. Certainly we haven't hit the meat and potatoes yet, but if anybody has any questions before we go into the servicing standards, now's a good time.
So we're getting a number of questions into the queue, and some of them are ones that we'll dive into, and we're going to answer directly in the presentation. But a few that we want to highlight. So here's one: are all lenders and servicers held to these guidelines, or just the 5 involved in the settlement?
Just the 5 that we highlighted earlier in the settlement. So only, but again, those are the 5 that we highlighted are the biggest servicers. Ally, which is in bankruptcy, so they're no longer in the picture, but certainly Chase, Wells Fargo, Bank of America, and Citi, if you remember that chart, are some of have the biggest market share in the market right now in terms of servicing loans.
Another question: is this part of the payments from Treasury under the independent foreclosure review?
No, that is a separate and distinct process, and homeowners can go through that process and get money from that as well.
Can a servicer ask a homeowner to waive his or her right for review under the MHA program if they accept an offer under the mortgage settlement?
And by MHA program, I'm sorry.
That's HAMP. It's
HAMP. Okay, just wanted to clarify that. I'm sorry. So can they waive?
Can they waive their right for review under HAMP if they accept an offer under the mortgage settlement?
Actually, under the terms of the settlement, they do get credit for doing a HAMP mod. So we won't talk about HAMP except in the context of the servicing standards, which we'll go through in a little minute, but they do get credit for doing the HAMP mod.
Yeah, and they're not waiving any rights under the mortgage settlement. It doesn't supersede HAMP and other rules. It supplements them. Is that fair to say, Odette?
Yes, and I'm sorry, I wasn't too clear about that. They certainly are not, the settlement did not waive any rights with respect to homeowners. They have all their full slate of legal protections, including the right to sue if they wish to. It preserved all of their legal rights. The settlement did not take any legal rights away.
And then,
okay.
So RG, will we run out of time?
Sure, I just wanted to move on. We'll have another opportunity.
Okay.
To ask questions in a bit, but I just wanted to make sure we got through the servicing standards. So here we have, as I mentioned, an agreement which has outlined 304 servicing guidelines that these servicers have to comply with. They are far-reaching and comprehensive, and we won't be highlighting all of them. Certainly there are great standards with respect to bankruptcy, great standards with respect to the handling of legal documents, we won't be discussing those. We'll be highlighting some that we feel are important for you as counselors to be comfortable with and be familiar with. The guidelines that we highlight, and the servicing guidelines in general, deal with almost every aspect of servicing the loan. So not just when the loan is delinquent or when it's in foreclosure. It also deals with pre-foreclosure process in some aspects as well. It was the servicers, so remember the servicers have these consumer relief provisions in the form of doing mods, doing refis, but these particular standards, complying with and processing loans that are current and in foreclosure, they were required to comply or be in full compliance with these particular standards as of October 2nd of last year. So no excuses by now. They should be comfortable with what these standards are. And the standards apply to all the loans that they're servicing, whether they're portfolio loans, whether they're loans that are owned or securitized by Fannie Mae or Freddie Mac, all of them. And what are the benefits?
Well, the standards certainly do benefit housing counselors in our work. They set clearer guidelines for the servicers. They provide more transparency regarding eligibility for loan modifications. Also, they limit dual tracking so that while an application is under review, the foreclosure process can be stopped or paused. Also, it encourages servicers to review applications in a reasonable time frame, which is very helpful to us. And Odette's going to describe one way for housing counselors to report violations of the settlement standards.
Thank you, Ellen. So we've been mentioning and highlighting this checklist, and we'll discuss in detail how this checklist works at the end of this webinar. But as Bruce mentioned, it is so important that we as a community, as counselors, start to really systemically document some of the issues that we're seeing with the servicers of this loan, both to give to OMSO in their role as enforcers, but also to look at some of the issues that are not highlighted regularly in the servicing of loans, like, for example, how are people who don't speak English as their primary language, or even currently, how are they faring in the process? How are folks with disabilities faring in the process? So along with the National Housing Resource Center, NCLC created a checklist. It's housed on NCLC's website and also Bruce's website. Our website address is www.nclc.org. Bruce, what is your organization's website address?
www.hsgcenter.org. So HSG is in housing, hsgcenter.org.
Fantastic. So look for this logo on our respective websites. But what it allows you to do is to simply go in, fill out a few basic information about your client, about the loan number, and then simply check off where you see that there is an issue with your client's loan. Has there not been a single point of contact? We'll discuss what that is in a minute. Has not been appointed to my client's loan. Oh, check that. They lost documents. Check that. And we'll see a visual of what this looks like in a minute. But it allows you in a streamlined way to report the violations of this servicing standards to various federal agencies and also to your state attorney general's office. And at the end of the process, you will get will be emailed, actually, a summary of what you have entered into the checklist so that you can put it in your client's file as a means of updating your client's file and also keeping a copy and a record of the violations that you've seen with respect to this particular loan file. We'll talk about using the checklist to escalate any problems you see with the loan. But first, let's discuss what are the actual standards. And if you're like me, you're probably more of a visual learner. So we have introduced a Sally Homeowner. Sally Homeowner is current right now, but as you'll see, the standards or the business practices that servicers have to engage in will change as Sally gets into default and goes further into the foreclosure process. But right now, we'll start with a homeowner, Sally, who is current. What must these 5 servicers, what are they obligated to do? Well, they're obligated to perform certain general tasks. At a minimum, and at the most basic, right, they have to send a monthly statement. No big innovation here. The standard is that the monthly statement is not required if the homeowner provides a coupon book for a fixed-rate mortgage. Now, this is one of those tools that is helpful for counselors, and I just wanted Ellen to explain a little bit how we can use this to help Sally.
Right. The new mortgage statement is required to include the payment allocations, payment changes, fees, and the escrow status. And this is really helpful for counselors when borrowers have questions about their payment changes and allocations. So it gives counselors the opportunity to try to find out what has happened with any changes by just simply looking at the statement, and they may not have to call the servicer to answer those basic questions.
Great. Another, again, basic requirement, right, but surprisingly folks run into problems with this, is that the servicers are obligated, the 5 servicers are obligated to accept and apply payments promptly. I could speak from personal experience. I had a client who sent in their payments, and those payments were applied between 5 and 10 days after the servicer received them. But under the servicing standards, the payments have to be credited within 2 business days after the servicer receives that payment. So 2 business days, so it's not 5 or 10. If your client sends in a partial payment that is within $50 of the full payment, they have to accept it. And if they apply a partial payment, if they put that money in a suspense account, I don't know how folks familiar with suspense accounts. Oftentimes when the servicer receives a payment that they believe is not the full amount that is due, they'll put that in a suspense, or another term for it is an unapplied funds account. Now, one great thing that the settlement does is that it has this rule which, if the servicer is taking money out of the suspense account to apply it to the regular account, they have to take out the principal and interest and escrow payment first before taking money out for servicing-related fees, okay? So the homeowner gets a full credit for a full payment before the servicer starts taking fees for late fees, not sufficient funds fees, all the other fees that are tacked on to the account when your homeowner is behind. Now we have restrictions on fees and charges. And Ellen, did you?
Yeah,
sure.
I'm here. The fees have to be bona fide and reasonable. They have to be disclosed in those statements that we mentioned. Also, they have to list the common fees that the servicer may charge on their website, and we'll look at an example of that in a moment. And if the borrowers request a fee schedule, that has to be provided to them. This shows an example of a list of common fees that we found on one servicer's website. And now, as Sally falls 60 days behind, let's look at how the standards are relevant to her situation. One of the settlement standards requires that the servicers reach out to the borrower early and often, and they're required to provide information about housing counseling and encourage a borrower to go to housing counseling. They're required to provide a single point of contact, and we'll talk more about that person's requirements as well. And then they also must communicate with the housing counselor if the borrower provides the third-party authorization form. The single point of contact that I mentioned is supposed to be knowledgeable about the borrower's situation, and they're supposed to remain available until the borrower brings their loan current or they exhaust all their options. So this should be someone who can help the borrower throughout the process. Also, it's helpful to know that the single point of contact should transfer their calls to their supervisor if they're asked to do so. And the single point of contact does have access to the people with authority to stop the foreclosure sale if and when that's needed. We'll go on to a poll question. Under the settlement, servicers cannot discourage borrowers from working with nonprofit housing counselors. True or false? And Jessica will post that. Thank you. We'll give you a moment to respond. And Jessica's posted the responses there. 94% of you said that that's true, and only 6% said that that's false. And that's correct. The servicers are required to encourage borrowers to work with a nonprofit housing counselor, which we all agree is the best thing for the clients, to help them to be educated about all of their options and to work through this difficult process. Another requirement under the settlement is that the loan servicers should create web portals or online loan portals. These portals should allow borrowers to find eligibility factors for modifications and also submit and track their documents electronically so that we won't have this issue with documents being lost as frequently. Then the loan portal should also allow the servicers to provide status updates every 10 business days and communicate with the borrowers to meet the written communication requirements of the settlement. The servicers' loan portals are really helpful tools, but I would say that they're supplemental to tools that many of the counselors are already using. I noticed that about 1/4 of the participants are still faxing documents into the servicers, and I would encourage you to either use the HOPE loan portal to submit your applications for your borrowers or use the web portals. Here's Citi's website, which shows an example of one way that you can find additional information on eligibility for the loan modifications. This actually has really detailed PDF documents that you can open to look at the eligibility factors for your borrowers and decide if they might qualify before they apply.
Hey, Ellen, I'm sorry to interrupt you. We're getting some feedback from your microphone. Can you just try to adjust it?
Yep. Sorry about
Oh,
that.
it's actually, nope, it's actually getting worse. Try. Unfortunately not.
Okay. Hold on 1 second. Let me try something else. Can you hear me now?
Yes, much better. Thank you.
It's going to take me a moment. I can't hear anyone else. Jessica, if you're talking to me, hold on 1 second. Okay, how does that sound now?
You sound good. Can you hear us?
Yes, thank you very much.
Okay.
Let's see. So we're going to go on and go back to Sally's situation as she falls 90 days behind. And she would go ahead and you would help her submit an application at that point.
So before Sally, thank you, Ellen. Before referring Sally to foreclosure, let's just briefly review. Sally's falling behind. She's getting in that zone where they might be getting the file ready to refer to the foreclosure attorney or trustee. But again, to review, they have certain requirements that they must meet under this settlement before they even can send that file over to the foreclosure attorney. And one ironclad rule is that they have to contact Sally. They have to let her know what workout options, not just mods, what workout options are available for her, what can she do. They have to assign, as Ellen mentioned, they have to assign that single point of contact if Sally does request assistance. And that person is to work with Sally to figure out, what will work, help Sally if she submits that loan, the application for a workout option. Now, if Sally does submit an application for a loan modification, they are obligated to evaluate Sally for each and every loan mod that they have on the books, whether it be HAMP, whether it be an in-house or proprietary loan mod, one that is offered by the investor or owner of the loan. Doesn't matter if it's an FHA, VA, or RHS loan, they have to evaluate Sally for those options as well as applicable. And they also have to send Sally a notice. Before Sally gets a letter from that foreclosure attorney, there is what's called a pre-foreclosure notice that has to go out. And that has to be sent at least 14 days before the loan file is referred to that attorney. Now, here's actually a great tool for you as counselors to request. Now, it's not going to come and it's not going to say on top 14-day pre-foreclosure notice, but they should get this notice, and it's full of a whole bunch of really valuable information. Number one, the servicers are required to outline in that notice, in this letter, any facts supporting their right to foreclose on Sally. They also must let Sally know that she has a right to request some key information. If she wants a copy of the note with all the endorsements, she can request it. A payment history, she can request that as well, and the name of the investor or owner of the loan. These are all key pieces of information, especially I would say the payment history, since she was last, I believe, 60 days behind, because you can kind of get a sense of if your client does not have that monthly mortgage settlement statement that we talked about earlier, and you request this payment history, you can certainly find out how much your client was sending in, what was going to the suspense account, what was being taken out of the suspense account, what was going to escrow, etc. So get a sense of the most recent history. And also, she can request, if that's not enough, an account summary. So look for this notice. There is another notice that we'll discuss later that comes after the referral to the attorney, but certainly this gives your client a right to request a whole slate of information that may help you when you're trying to counsel him or her earlier in the foreclosure process.
Well, we mentioned the online web portals earlier, and some of the servicers have created web portals that allow clients and counselors to submit their scanned documents electronically, and here's an example of one. We can go on to the next slide. You can also check the status of your submissions through the web portals. And now Odette will speak about rules for loan modifications.
Absolutely, but we can stop and take about 2 questions here, Bruce, if there are any, before we move on.
Sure. So the settlement, one question is, the settlement has a shelf life. What is the end date for it?
It's mid-2016. I don't have the exact date, but it certainly is meant to last 3.5 years.
And then we've gotten a couple questions about, well, this one says, according to the National Mortgage Settlement website, GSE loans are not eligible for parts of the settlement. A previous slide said that Fannie and Freddie loans are included. Please clarify.
That's a great question. They are not eligible for the consumer relief provisions, specifically the write-down of the principal loan amount. for the modification. But they are, the servicers, if they have GSE loans, they do have to service those loans according to the servicing guidelines that we are discussing today. So all the guidelines that we discussed today, if it's a Fannie or Freddie loan, it applies.
Good. Do you want to take another, or is that two of the
Sure.
next?
Why don't we take one more and then we'll move on.
If a Bank of America loan is sold to another entity, not one of the big five, what responsibility does the new servicer have?
So they do have the responsibility to abide by the servicing guidelines, as we mentioned earlier. They are obligated to, if they are in the process, if the homeowner is in the process of applying to a loan modification, they have to finish processing that application and give the homeowner the benefits that are they're obligated to receive under the settlement. Joe or Michael, did you have anything to add on that in terms of the transfer of servicing to a new servicer that is not covered by the servicing standards?
No, you got that right, Odette. And in fact, the onus, if you will, on making sure that the receiving or the new servicing, the servicer, is on, say, Bank of America in your example. They're required under the settlement to make sure that their servicers that they transfer loans to comply with the servicing standards. So you got it right.
All right. So why don't we move on to the meat and potatoes? I mean, and you guys are probably dealing with a lot of loan mods, and we have so many rules and important rules that are part of this settlement with respect to loan modifications, because it's important. So as I mentioned, one of the ironclad rule is that the homeowner has to be evaluated for every loan mod option, CAMP, FHA, VA, in-house. But also, I think, importantly for a lot of folks like counselors who you're dealing with so many programs, and you don't quite know how the standards for one program differs from the standards for another program. The servicers have to make the information publicly available. If they have an in-house program, they have to at least post basic information on what the process is, what the eligibility standards are. So it really, I think this is one of the key parts of the settlement for as counselors, is that you're not supposed to be putting your client's loan in a black box anymore. You're supposed to have at least minimum sense of what the different programs are that the different servicers are offering for modifying loans. Another really great part of the settlement is that it has a standard, which I don't know if there's a standard like that anywhere else, which obligates the servicer to offer your client a loan modification if the net present value test comes back positive. Now, for those of you who are more newer to doing this type of counseling, in the net present value calculation, the servicer is looking at whether, from the investor's perspective, the owner of the loan's perspective, whether it makes more sense to modify the loan or to foreclose on the loan. Are they going to lose more money in the foreclosure process than they would give up if they modify the loan, perhaps by reducing the interest rate, et cetera, et cetera? And if it is yes, they will lose less money from modifying the loan. It's NPV positive, and they have an obligation to offer your clients a loan modification. The other key parts or key requirement on this settlement has to do with HAMP. If some of you were around a couple years ago when the HAMP program originally started, you know that when it rolled out, it was less formal than it is now, right? I mean, now you have a 200-page handbook that the servicers have to abide by, and then it was rolled out with a 20 or 30-page letter. And so it was there were less standards. The homeowners were not required to be pre-qualified before they were offered a trial period plan. They were simply put on the plan, and then the income and other information was verified later. Well, you know, long story short, counselors on this call, you know how the HAMP program kind of evolved, and that a lot of folks were on these trial plans for really beyond the original 3 months or 4 months that they were supposed to be on the plan. If you have a client that was enrolled under these original HAMP guidelines, they now have another bite of the apple. They have a second opportunity to reapply for HAMP. Or if they don't want to reapply for HAMP, they could also apply for in-house modification. But they, if they reapply, they have to apply using current incomes and current guidelines. So that's one caveat. But they would also have been required to have made all of their trial period plans under the original program, but were denied a permanent mod. So if they made their trial period plans, were current, and wanted to reapply again for HAMP, this gives them a second bite of the apple. If they do reapply, then they are simply having the most current version of the HAMP program. Another important requirement with respect to HAMP is that homeowners who are on the HAMP program currently, on the trial periods plan, have to be converted to a permanent modification. Okay, so if they've been current on the trial period plans, meet all the other guidelines, they have to be permanently, they must be offered a permanent mod right away, not 5, 6, 7 months from now. Okay. Other requirements with respect to loan mods. What happens if the homeowner is denied? They submit the application and they are simply denied the loan modification. Well, a couple things must happen. Before they are denied the modification, the servicers, the 5 servicers, have to do an automatic internal review process. Your client nor you are aware of this process. It's internal, it's behind the scenes, but it is required. And what it simply means is that the servicer will appoint somebody who was not involved in the initial decision to deny the mod. Another employee has to review the file and has to certify that this file, yes, they're going to deny this loan mod. But this standard only applies if the loan that was denied was a first lien mortgage. So it's limited in scope. Okay, so the mod was denied. There was an internal review behind the scenes, and it's still denied. What must the servicer do? Well, they really have 3 kinds of obligations. Number 1 is to send a letter of denial. 2 is to allow the homeowner to appeal the denial if they want to. And 3 is to process that appeal in a timely manner if the homeowner submits an appeal. That denial notice that we mentioned has to go out within 10 days of the decision. And if the NPV calculation was the reason for the denial, then 2 key pieces of information. Remember, it's an NPV. I mentioned it's sort of a calculation weighing 2 different factors, right? And there are a lot of values and a lot of information that go into the calculation. And 2 key pieces of information is the monthly gross income, your client's income, and property value, because that can change whether the analysis results in an NPV positive or NPV negative. So when your client receives that denial letter, I would pay attention to the reason for denial and also scour whether, especially the property value, whether the property value is correct or accurate. And if not, the homeowner has 30 days, or I'm sorry, the homeowner can request that the a full appraisal be done, and that is at the homeowner's expense, unfortunately. I'll go back 1 slide and let you know that the homeowner has 30 days to request an appeal, so the denial letter will let the homeowner know that. You have 30 days if you want to appeal this decision. And in that 30 days, not only must they decide whether they want to appeal or not, but they also have to gather the information to dispute or to give the servicer that they could properly process the appeal and determine whether there was an error in terms of the decision. Once the homeowner submits their appeal, the servicer has 30 days to make a decision on whether to grant the appeal or grant the loan modification or deny the appeal. And if the appeal is denied, then a letter has to be sent to the homeowner letting them know that the appeal is denied. And now we're going to review the timeline for briefly for the loan modification.
Great. This gives you a visual overview of the timelines that Odette just described, and that within 3 business days of the servicer receiving the application, they have to acknowledge receipt of the application. Then they have to notify the borrower of any missing documents within 5 business days. And a key time frame for you as counselors to keep in mind is that the borrower only has 30 days to submit missing documents. And finally, then the servicer has 30 days to review the application, approve it, and send a trial period plan. Then once the borrower receives a permanent modification offer, they only have 14 days to sign and return that. And then the servicer has 45 days to return a signed loan modification agreement to the borrower. This is a chart that's located in the handbook that you're going to receive after the webinar, and this gives you a little bit more detail about the timelines that we just discussed. To give you a visual of the appeal process, if the modification is denied, the borrower has 30 days to request the appeal and submit additional documents to correct any errors or misunderstandings in the original application. Then the servicer has 30 days to review the borrower's documents. If the appeal is denied, then the servicer has to wait an additional 15 days before they continue the foreclosure process. We have another poll question. Under the settlement servicing standards, how many days does a borrower have to appeal a denial of a loan modification request? And Jessica will put the poll up on your screen.
While everyone is answering the poll question, I just wanted to chime in that there are so many dates and deadlines. Some are business days, some are calendar days, and it can be quite confusing. So I would recommend, again, as a resource to use the handbook that we will provide, and you can simply say, well, where am I in the process and how many days does the servicer have to respond? Because we're not expecting you guys to keep in mind, like, this is 14 days, this is 30 days, this is 20 days. It's just, it can be a lot of information to process.
And we have the responses from the poll on the screen. 17% of you stated that 14 days would be required from the date of the denial letter, 10% said 15 days, and 73% said 30 days. And the correct answer is 30 days from the date of the denial letter. That's the length of time that the borrower has to appeal the denied loan modification. So keep that in mind, counselors.
Thank you, Alan. So we are going to go a little bit into using that checklist that we mentioned. Again, it's on our respective websites, National Consumer Law Center and National Housing Resource Center. And one of the reasons why we created this this form or this tool is that we realize that, number one, there are so many standards. It's hard to keep track of what the standards are. And it's harder even to find time in your day while you're helping clients to figure out when and where to report any violations that you see of the servicing standards. So we're trying to make this as useful and user-friendly and as easy as we possibly can. What you'll see is when you go to NCLT or you go to the National Housing Resource Center's website and click on the checklist, you'll see this is the intro page. As simple as can be, you have a paragraph that describes the settlement and a paragraph that describes the checklist, nothing more. And you simply have to check on whether in the bottom left-hand corner, whether you're a housing counselor, an attorney, a homeowner, and checking that box will just simply give you an option to check off what's going on with my client's loan file. Are they losing docs? Are they not getting back to me? Is the single point of contact really not knowledgeable about my client's case? And within 2 clicks, you should be able to report what the standard is that has been violated with respect to your client's file. So, for example, on the screen you see that in this case there was a violation of the single point of contact. It didn't do what they needed to do. And their failure was that they failed to communicate the options available to the homeowner so the homeowner could consider the options. So within 2 or 3 clicks, click, you have identified what you think is wrong with your client's, the servicer's processing of your client's loan. You see the number 5, for example, lost documentations. Within 2 clicks, you just simply report that the servicer has lost your client's document. Now, we have only 17 options to click off, and that is by design. We didn't want to overwhelm you. But of course, if none of these fit, you can click number 18, which is Other, and there will be space for you to describe what's going on with your client's loan, and there's a space, also a box for you to add a narrative and as much detail, and we encourage you to put a lot of detail in this. But tell us what's happening, tell us what the servicer has done wrong, and that will help when you decide to send this form or submit this form either to the state AG or to a federal agency that can help. Now, to help you in that process, to help you escalate these forms and escalate these complaints, after you submit the information to the checklist, you will have a screen that says, thank you for completing this checklist. And by the way, do you want to submit this complaint further? And if you want to submit it to your state attorney general, information regarding your state AG will be displayed on that thank you page. Information regarding the CFPB, HUD, OMSO, and others will be displayed on this thank you page so that within a couple of clicks you can not only report the information to us, but also report it to these other agencies and get further assistance and get further help. And again, we will discuss next week how you can use this form to escalate and help your client, but we just wanted to introduce it to you. One of the key features that you will get is an email after you've submitted the form. An email will be sent to you with a PDF, and the PDF will simply summarize everything that you have submitted to the checklist. You can keep that, print it out, put it in your client's form, file. Later on, perhaps, if you didn't complain to the AG and you say, oh, later on, it's like, oh, you know what, now's the time to complain. You have that form on file, and you can use it and submit it later on. So it's useful to have a summary of everything that you have submitted thus far. And so now we're going to end with a case study.
Well, let's put some of this information to use. And here we have a scenario about Sally Homeowner. She submitted a complete application to the postal address given by the servicer. However, she never received confirmation of receipt. Then she received 3 more of the same application packages to fill out. She tried calling the representative with no success. When she did get a call from the representative, she was told no documents had been received. So considering this scenario, which of the following servicing standards were not met? You can select single point of contact, lost documentation, or the loan modification timeline. Great. Most of you selected either single point of contact or lost documentation, and that's correct. Either of those answers would be correct. And then you can use this information and report it to the checklist as was described earlier. Can we go on to the next slide? Thanks. So again, we go back to the example of the loan checklist, and you could select the single point of contact failure because the borrower was not able to reach the single point of contact. And then you could also select lost documentation because the first applications were lost. So I encourage you to think about how you can integrate the checklist in your regular workflow. One of the ways would be to consult the checklist throughout the counseling process. During the initial appointment, you're probably going to hear some descriptions or complaints about how the process has gone so far. Maybe your borrowers have already experienced lost documents or failure to be able to contact a single point of contact. So there may be an opportunity right away to fill out the checklist. And then also after you submit an application, the checklist can help you to keep track of the deadlines or time frames of when certain notifications should occur. And then also if there's a referral to foreclosure, then the checklist would be helpful to track those time frames. After approval of the loan modification, and finally after denial of the loan modification. So please keep this in mind to help us report the failure of the servicers to complete or meet the standards of the National Mortgage Settlement so that we can make change in the future.
Awesome. Thank you, Ellen. So we have a few minutes for some questions. And Bruce, what do we have?
Okay. We've gotten a couple questions about single point of contact and about are there rules about how often a single point of contact can be changed?
You know, I don't think there are. I think they're silent on how often it can change. I think the standard is that one has to be appointed. So I don't recall any specifics as to whether if one is appointed and they go on vacation, then another person can't be appointed. I think they can. But at least one person must be appointed.
That's correct, Odette. This is Joe Chambers, and just to add to that, it's that when there's a change, say someone leaves the job and there's a new single point of contact that's assigned to the borrower, the servicer is required to communicate that to the borrower or the housing counselor just so that they know who the new contact is.
So another question, when we ask the servicers for the name of the investor, most cases they say the homeowner has to request in writing, which can take over 30 days, and sometimes customers cannot wait 30 days.
That should be available. I'm sorry, go ahead.
No, that's it.
I'm sorry, Bruce? Oh,
go
okay.
ahead.
They should be able to provide that information pretty quickly. I don't recall any timeline as to days, how long it should take. Let me say, this is a big difference between the National Mortgage Settlement and the CFPB mortgage servicing rules. The CFPB rules do mandate that information must be provided within 10 days. But it's silent as to, the settlement is silent as to how long they can take to provide that.
With the new national standard, did you say the servicers have 30 days to approve a trial mod if all docs were submitted?
I'm sorry, what was that? Bruce, could you repeat that?
Oh, sure, absolutely. Just scroll back down to it.
I'm sorry.
With the new standard, with the new mortgaging standards, did you say the servicers have 30 days to approve a trial modification if all docs were submitted?
Yes, they have 30 days after receiving a complete loan modification application. So next week, when we do part 2, we will talk about what is considered complete, because that sets the clock ticking. And I think oftentimes that's where folks are having the most struggles with out there in terms of what is and what is not complete.
Is there a database, even by a lender, where counselors can input the loan number to identify if the borrower is eligible for benefits under the settlement?
This is Ellen, and in my research I didn't find anything that could specifically do that. However, they do post the eligibility standards for the modifications, so you would have to be familiar with your borrower's situation and information about the loan that they have, and then compare that to the standards that are posted on their websites.
What are the benefits for the homeowner knowing who the investor is? What will they be able to do with this information once obtained?
That's a great question. So oftentimes, well, I won't say often, but theoretically the homeowner or the counselor can escalate any problems with the servicer to whoever owns the loan. Because the owner of the loan is the one who is calling the shots. They hired the servicer, they're paying the servicer. So they'll be on the hook if the loan goes into foreclosure. So they certainly want to know that the loan is being serviced according to whatever agreement or guidelines the servicers agree to abide by. But we understand that sometimes some owners of loans are more hands-off than others, and that they delegate a lot of discretion to the servicers.
What if the homeowner completed all trial payments with the previous servicer, such as Bank of America, and the loan is transferred to a smaller servicer like NationStar? Why do homeowners have to start the process all over again in this case?
They shouldn't have to start the process all over again. The NationStar, if they are receiving the servicing of the loan, should be abiding by the terms of the settlement, and the servicing of that loan should be continuing. The homeowner shouldn't have to start from phase one. They should be continuing from wherever it is that they left off when the loan was transferred.
Yeah, I think that's one where people are having problems, so this is an excellent question to ask. What are the dates for the next series of the presentation? How to get to part 2? And somebody says thank you at the same time.
Well, fantastic. Well, this is a great question, because part 2 is coming up on the 24th. And we also have another part 2. If you missed the 24th, there is another date in that week. And I'm so sorry I don't have that date right in front of me, but part 2 is next week, and we'll have 2 part 2s, one on earlier on June 24th, and I believe one a day or so later. But check on NCLC's website, and Bruce, do you have that information on your website as well?
We do, yes.
Awesome. So, and I encourage you to go to Bruce's organization and check out his website, because it looks like you have so much great information, including that new report that we are all looking forward to reviewing.
Do you want to take another one?
Let's see. I think we're out of time, unfortunately.
Right.
I know
Okay.
that there are lots and lots of questions. I want to thank you. You guys have been a great audience. We certainly hope that you will continue to put questions in the box, because if we don't answer them, or if we didn't answer them today, we'll take a look at them and see if we can answer them on part 2 of the webinar. But thank you again.